At some point, everybody has commented on this. JLC raising prices by 40%. But nobody has really dived into why. That's what I'm going to talk about. JLC raised their prices massively. Why did they do it? And more importantly, will it work? As per usual, let's dive in. Quick recap. JLC have, like what feels like everybody else, raised their prices. Rolex, Omega, Seiko, everyone has been raising their prices. The high-level reason is boiled down to wanting to be more exclusive. JLC caught the headlines though because they more or less raised prices overnight by 40%. Models like the brand new JLC Reverso actually had its price raised from the time it was announced before it even made it into the stores. That's wild. Imagine Apple saying that the new iPhone will cost $2,000 and the next day going out and saying, oh, it's actually $2,800. That's basically what JLC did. A monoface Reverso went from $6,000 to $8,000. The Polaris went from $9,000 to $11,500. A duoface went from $9,000 to almost €13,000. And the Chrono Reverso went from, I think it's about $21,000 to $25,000. Could it be costs? Costs have after all gone up. COVID disrupted supply lines. Supply of key resources fell, all while every manufacturer in any segment, not just watches, raced to get a hold of the materials and components they needed to deliver to an almost rabid market. Consumers were bored out of their minds and just started buying stuff, including watches, because what else were they supposed to spend their money on while sitting at home in lockdown? Coming out of lockdown, a conflict shakes the world order and rocks global prices of pretty much everything. Gold, oil, gas, steel, corn, you name it, everything got more expensive. Of course producers had to raise prices, but 40%? This is where we have to focus on the numbers. It's basically impossible to get data on specific watch firms. Rolex and Tudor are private firms that do not publish their results. Same goes for Patek and AP. The rest, well, pretty much all of them are either owned by Swatch, Richemont, or LVMH. I do not know how much JLC sold for last year. Morgan Stanley has some estimates, but they are largely high level. I still think, though, that we can approximate things a little bit. From the annual report of Swatch Group, you can see that they grew their top line by 2.5% from 2021 to 2022. Their bottom line grew by 11%. Sales grew more than costs. Swatch is 18% ahead on their top line for the first half of 2023 compared to 2022. So things haven't really slowed down, not yet at least. LVMH grew their top line by 18% within watches and jewelry. Bottom line, 20%. Sales grew more than costs. Richemont, well, they just released their numbers for 2022-2023. Bottom line went up by 19% versus 17% the previous year. 24% improvement on the bottom line on a 13% revenue growth. So they made more per watch. Costs did not outpace revenue growth. But what about inflation? Well, in Switzerland, the inflation rate hasn't been above 4% for consumer goods the past 2 years. Inflation in the United States topped at just under 9%. That's nowhere near 40%. This is a lot of numbers, I know, but stick with me. I'm doing this deep dive so JLC can't argue that they had a specific cost driver that is key to their increases. I've got the last bit of numbers to go through. So what we're talking about is when building a watch, you have the following key costs: materials, manufacturing, power, people, marketing. It's those 5 things and some buildings that make up the vast majority of your costs. What do you think is the main cost driver? Power's a thing, but it's not top 3 except when prices briefly were at their absolute maximum. Materials got maybe 6 to 8% more expensive on average, and year-on-year power costs were, I think, likely unchanged. Everything boils down to marketing, people, and manufacturing. When it comes to marketing, I guarantee you this. In a time of turmoil, inflation, combined with a period of rabid customer demand, nobody's going to spend more on marketing. You make do with what you have. No CEO is allowing a 40% increased marketing spend. That budget did not change by as much as $1. That leaves 2 major cost drivers: manufacturing and people. If you're Tudor, you have less people and rely more on manufacturing. Because if you can use a machine that can be used in an automated process, you do that. For Lange & Söhne, people costs are most likely higher because there's a higher degree of man-hours that go into those intricate hand-engraved dials, cases, and movements. Why is this important? Well, JLC probably uses more man-hours per watch than Longines, Tudor, or even Rolex. They don't have the same scale. Their models are more intricate, so it's more man-hours. Not as much as Lange, but the share of people costs is going to be higher, which begs the question, did JLC raise salaries by 40% last year? No, of course not. My estimate, I mean, they raised salaries by somewhere between 3 and 4%. And I'm being really generous because the average salary increase in Switzerland over the last year was 2.5%. So I'm really being large on that one. With a larger cost base allocated to employee costs, you're now in a spot where what you got left is manufacturing costs, potentially having to go up by 50 or 60% to make the total cost go up by 40%. That's what we're talking about. Now, as for manufacturing, they didn't, as far as I know, build a new facility last year. They probably upgraded a couple of machines, but at the end of the day, the machines they replaced also got 6 to 10% more expensive, but that cost gets spread over 7 to 10 years of use. Nothing on the cost side drove manufacturing costs up by 40%. End of story. On average, maybe they had 10% cost increase, and we know they totally recouped that on the top line. Costs were not the reason. The reason I covered costs was just to shut it down. We all intuitively knew that costs weren't the main driver of these price increases. There are two key reasons, and the first one is positioning. Let's take a look at a relatively standard entry-level men's watch from JLC, the monophase reverso. Not long ago, it cost $6,000. Now it costs $8,100. In the before scenario, the entry reverso cost the same as an entry-level IWC Pilot Mark 20. The IWC Pilot about 2 years back got more expensive as well when they phased out the ETA movements and started putting in in-house movements. But, an entry Panerai costs about $6,000. Cartier costs about $6,000, $8,000 for a popular model like the mechanical Santos Dumont or the Santos de Cartier. Tudor will set you back $3,500, $4,000 for an entry Black Bay or a Pelagos. Hublot, $8,000 for a classic Fusion. Richemont and JLC did the math. They looked at the market and said, we have a better and more exclusive product than Tudor, IWC, and Panerai. Some of them are also in the Richemont group, of course. We have more history. We have more exclusive movements. We are the brand that delivered movements to Patek, Vacheron, and I think also AP. In all fairness, I tend to agree. Their watches, based on their historical legacy and also the pure quality of their watches, the Reverso, the Duofaces, the Master Series, and even the uber luxury Polaris, being priced like an IWC seems, intuitively wrong. They should be more expensive than IWC, or an IWC should be cheaper than a JLC. Either way. JLC had to move up to maintain their position as a high-end watch maison. Being stuck price-wise with IWC, Panerai, and even Omega is not how JLC see themselves, and I don't think most people in the watch industry will disagree. Price does indicate quality and status, so they had to raise prices, and they probably hadn't been aggressive enough for many years. You'll find lots of watch dealers online saying, JLC has been very good value. That's dealer speak for they were underpriced. The reality is, though, that they probably only needed to increase their prices by 10 or 20% on top of cost coverage. It still doesn't explain 40% or more on some models. It doesn't explain some models, relatively speaking, suddenly becoming by request only models that previously would have been readily available. Which brings us to the more speculative component, exclusivity. Quick history lesson. When the quartz crisis went down, the brands that did the best were the ones that succeeded in transitioning to luxury. They redefined their product as not just a practical time-keeping device, but a luxury good. I think this time around, JLC, picked up the phone, called Boston Consulting Group or McKinsey or somebody similar and asked if they could go even more high-end. Think of all JLC buyers along a normal distribution curve, from those with a lot of money to those with relatively not as much. Prior to COVID, all brands had a natural curve where the low end, the end where we had the entry buyers, was fairly far up. Lots of people looked at the price of an entry Rolex, an entry Omega, or an entry JLC and just said, that's too steep for me. But things changed in the last 3 to 5 years. Growth, strong economies, low interest rates, and other factors led to the number of entry buyers willing to buy an entry watch growing. The high end grew too. We got more rich people, but I think, and I've said this before, the low end grew disproportionately. Customers that weren't typically JLC or Rolex buyers became JLC and Rolex buyers now. And Rolex and JLC and other brands made a bucket load of money. Everything grows, but now JLC and others had a problem. Their brand was becoming perceived as less exclusive. More people were seeing them as accessible. So what do you do as a business? Well, you can embrace the reality where you've become, relatively speaking, mainstream, or you can regard it as a threat, that you're eroding your exclusivity and that will hurt you in the long term. The solution? Raise your prices so you cut off the low end. Reset your position so you become less accessible, as unaccessible or even less accessible before than you were prior to this period of growth. You do this on the conviction that your Reverso Tributes, your Reverso Chronos, your Memovox, and your green Polaris will still attract the right customer. So you raise prices by 40%. You annoy some entry buyers, but hey, if you raise prices by 40% and your costs have only increased by 10%, that's a 30% differential. Bad math, but you get my point. You can stand to lose 1 in 3 entry-level customers, and you'll still make the same top and bottom line. Plus, you also get some additional cost savings in not having to make as many watches. It's a gamble for sure, but they definitely did their math. That's what I think, at least. The question is, will it work? Not in the short term. I know it's a bit of a statement, but this is back to that boardroom where those McKinsey or Boston consultants were presenting the recommendations. They made their suggestions based on the way the world looked at the time, and things have changed. Prices are dropping on everything. Even Rolex is becoming available. Not the Daytona or the GMT, but you can get a Sub, a Datejust, or an Oyster Perpetual. They're all gettable. Rolex is the definition of the most desirable brand, broadly speaking. And if they're not as in demand, I mean, they're still selling their watches, I'm not saying they aren't, but they're moving at a more normal pace. Jaeger-LeCoultre, though, isn't Rolex. They're not as hype. They don't, apart from maybe the Polaris, have nearly the popularity that Rolex and Tudor and Omega designs have. Fact is, the Reverso is cool, but a majority these days want a dive watch. Those consultants probably presented 4 scenarios saying the best case is where we see no negative impact on the top line and the bottom line grows. At the other end, they had a scenario where they took a hit on the top line revenue and on profits in the short term. My guess is that Jaeger-LeCoultre will hit somewhere in the middle scenarios where they take a hit on the top for sure, but the bottom line carries them through at the same levels. Is it going to kill them? No. But if those consultants did one of those tables with 4 scenarios ranging from best case to worst case, Jaeger-LeCoultre is definitely not in the best case scenario. In the short term, more than 1 in 3 entry clients are going to hold on to their money instead of buying a newly more expensive Reverso. The Reverso Chrono is still going to be super desirable. I don't see the Polaris falling out of favor. But in the short term, Jaeger-LeCoultre won't see this as a full demolishing win. What it means for buyers, though, I think 2 things when it comes to buyers. Jaeger-LeCoultre is going to be even more gettable on the secondary market. If you even check the watch charts or Chrono 24 right now, you'll see that the Polaris is trading $2,000 or more below the new retail price. That's a lot. I actually have a hard time finding a model on watch charts or Chrono 24 that was trading above their old retail prices. So if you're willing to wait a couple of months after an initial release, most models will be cheaper, if not significantly cheaper on the secondary market. In the medium term, Jaeger-LeCoultre can readjust by not raising prices as aggressively from year to year until they find a level that is in line with the brand perception and the demand they want. I love Jaeger-LeCoultre. I have a Reverso Tribute Moonphase. My wife has a smaller Reverso Monophase. I dig a Polaris, but Jaeger-LeCoultre overplayed their hand in the short term on this one. The price increase is not justified in costs. I'm okay with brand repositioning, but the market doesn't allow for such an aggressive adjustment. This was a mistake from a business perspective and more importantly from a customer perspective. 40% just comes across as greedy, and if I'm wrong about the costs, well then they're running their business completely wrong because nobody just got 40% more expensive last year. Good news, secondary market is going to become interesting again. Time to pick up a discount green Polaris. That's my thinking at least. What's your thinking? Let me know in the comments. Like, subscribe. Cheers.